Hi, great to have you here. Today I'll teach you how to identify trending and ranging markets. This is one of the most important skills any trader can have. First of all, please do remember that we don't provide any investment advice and all the material is made available for educational and marketing purposes only. And please remember to subscribe to the channel. That would be a great help. Thank you. If you are new to trading, you might wonder why this is so important. But actually, if you get this right, trading will be so much easier for you. You'll be on the right side of the market and it'll be so much easier to find the right trading opportunities. So let's dive in. First, I want to show you how you can use fast and slow moving averages to identify markets that are trending higher or that are trending lower. Here I have gold in 1 hour time frame. I have added two moving averages on the chart. One of them is 50 periods, this one here on the red, and the other one is 30 periods, the one on orange. And the indication is, and this system is so easy that you can learn this very quickly. So the indication is that the market is bullish or it's trending higher when you have the fast moving average above the slow. And once the market moves further, there'll be a point when orange moves below the red, i.e. the fast moving average moves below the slow moving average. And after this, the trend is over. The uptrend is over. The market is probably not moving higher anymore. It's in this occasion, the market starts to move sideways. As you can see, there was some sideways movement, and then we have an opposite situation here. Here the fast moving average is below the slow moving average and the market is trending lower. So this is one of the tools that you can use. As you can see, when the market moves sideways, the moving averages are here in the middle and the price fluctuates in wide swings around the moving averages until there comes a point when the supports break and the market starts to move lower, and after that you have the fast moving average below the slow. When the price action later on turns less bearish and the market starts to move sideways, the moving averages highlight this by moving sideways, and then the fast moving average crosses above the slow, i.e. the orange above the red in this case. Obviously you can use any colors that you like. Let's talk about the ADX indicator next. This indicator helps traders to see if a market is trending or not. While it's not perfect, this basically means there are false signals, it really can provide some additional guidance on your trend analysis. So let's take a look. Okay, here's the indicator on gold daily chart. As you can see, down here we have three lines. We basically have the ADX line, which is on blue, and then we have DI plus line on green and DI minus line on red. And the idea is that when you have the green line above the red line, then there's an uptrend. And as you can see on the chart, yes, the price is moving higher quite strongly actually. Then if you still concentrate on the red and green lines, you can see that here they are kind of zigzagging. There's false signals and suggesting to you, indicating to you that the market is moving sideways, which it is. Now let's look at the blue line. This blue ADX line tells you the strength of the move. So if the ADX is very high, like here, it means that over the period before it, there's been lots of trending properties in the market. So lots of momentum in the market. So you could call it a momentum indicator. So if there is lots of momentum to the upside, the ADX line will go higher. This is a good highlight that yes, there is a strong trend in the market. And then when the price starts to move lower, obviously the first thing you see is the ADX line turning down because you don't have those uptrending properties anymore in the price. And later on, this top turns into, after some sideways movement, this top turns into a down market here. The gold market trends lower for a period of time, and this is where the red line is moving above the green line. And again, the blue line is telling you how strong the downtrend is. Then I want to show you Bollinger Bands. They really are a great tool for markets that are moving sideways. This is probably the best indicator for recognizing the markets that are moving sideways. So let's go to the charts so that I can show you what I mean. Here we have EuroCAD in 8-hour time frame, and as you can see, the market moves down, then it moves sideways, and then it moves up. So this is a great example. I think this point in time shows you very clearly how the behavior of the bands changes when the market or the price action changes. So here we have the down move, and then starts the range. And when you see the market bouncing sideways between these ranges, you know that there's a great likelihood that you are in a trading range and you can sell the highs and buy the lows, and eventually there'll be a breakout, obviously, but until then there's money to be made in the range. Then later on, once the market has moved above the high of this sideways move, the upper band here, then the price moves above the moving average. The middle band here is the moving average. So it's basically the price is moving between the middle band and the upper band. And that's an uptrend. If you go and look at the left-hand side of the chart, you can see how the price moves down to the downside, and it moves between the lower band and the middle band. So it's a great tool, especially for sideways markets, but you can still use it in trend analysis and trend identification as well. You might know that all the indicators that we have covered here are just derivatives of price action. So whatever the price does, the indicators will do after it. This is why I'm going to now talk about price action, which is the best indicator. It is the best tool for you to recognize trending and ranging markets. Let me show you what I mean. As you can see here, the market is trending higher, it creates higher lows, higher highs, and then it stops moving higher. We have here, let me copy this, we have here a highest high, then a reaction to the downside, and then a lower high, and then another that is roughly an equal high. At this point, we know that the market isn't making new higher highs, but it still isn't making new lower lows either. So it is in a range. And as we move forward, we get more confirmation that the market is actually moving sideways. It just can't move beyond this range or the boundaries of this range. Then there'll come a point at which the market breaks out, and this breakout leads to a bigger move. And again, we have the same sequence there. The support was broken. Then we get a lower high, and that results in a series of lower highs and lower lows. So hopefully this gives you an idea on how to analyze the markets and recognize the trends and ranges, because obviously when the market is trending higher, you want to be on the long side, you want to buy the market. And when the market moves sideways, you can buy the bottoms and sell the highs, and then in the downtrend you should be looking to sell the rallies or the breaks below the supports, whichever style you prefer, but you should be looking for sell signals. So if you remember that you should be buying when the market is moving higher and selling when the market is moving lower, you are putting the probabilities on your side, and it helps you tremendously as you look for great trading opportunities. Thank you for watching, guys. It was great to have you here. So now I would like you to take a moment to go to tiomarkets.com to register your own trading account and also to subscribe to this channel. Turn on those alerts so that you get notifications when we have new videos available for you, and really go and get your own Tio Markets trading account so that you can start building your own trading business.